Subscribe to my channel Report Stock.
All right, let's just jump right into this. Imagine you're watching a company kind of in the middle of this massive makeover, shedding its old skin, for a digital-first asset-light future. But is this radical transformation really working? Today, our mission is to peel back the layers of TH International's Q2 2025 earnings.
Exactly. We're not just going to dump numbers on you. We've gone through the earnings call, the reports, the highlights, and the Q&A. The source material is TH International Q2 2025, Growth, Expansion, and Strategic Shifts. Our goal is to pull out those vital nuggets of knowledge, understand the strategic shifts, and highlight both the successes and, well, the challenges too, so you get a clear, informed picture of where this company is truly headed.
Think of it as your shortcut, right? Knowing what's truly important without having to sift through all the jargon yourself.
So if we zoom out to the big picture for Q2, what's the headline for TH International? It's not a simple, straightforward story, is it? No, definitely not simple. What you see is a company in a significant transitional phase. Overall, they presented a mix of, let's say, modest system sales growth, but crucially, some very deliberate strategic adjustments are beginning to show real impact, especially on their path back to profitability.
Okay, let's get into the hard numbers then. What do the key financial highlights tell us about this mixed performance?
Well, system sales growth came in at a modest 1.4% year over year. Not exactly explosive, but, it's still growth. What's really insightful here, though, is the food revenue. It surged by 8.6% year over year, and it hit a historical high, contributing 35.2% of their total sales. That's up quite a bit from 32.5% in Q2 last year.
35.2%, that's a big chunk. More of their revenue coming from food itself.
Yep.
What does that signify? Is it like their product strategy, customer preferences maybe? Is this a deliberate pivot, do you think?
It really looks like a deliberate pivot, or at least, a highly successful execution of their core product strategy. It suggests their menu, their marketing campaigns, the operational focus, it's all resonating. Customers are spending more on the food offerings. That's pretty key for a fast casual brand. And on the profitability front, they actually returned to positive adjusted corporate EBITDA.
Okay, you mentioned adjusted corporate EBITDA. For listeners who might not track this metric, like every single day, what exactly is it, and why is turning positive here so critical for a company like THCH?
Yeah, good question. So adjusted corporate EBITDA, it's basically earnings before interest, taxes, depreciation, and amortization, but with certain kind of one-off adjustments removed. When it turns positive, it means the company's core operations are generating cash before you factor in things like financing costs, taxes, or non-cash stuff like assets losing value over time. For THCH, getting back into positive territory here is a huge deal. It signals that their operational investments, like, closing those underperforming stores, improving cost structures, they're actually paying off. It's moving them towards self-sufficiency in their day-to-day business, getting leaner, more efficient.
Right, so a strong sign of operational health then. And their adjusted net loss was also reduced, you said, by about 16.2%.
That's right, reduced by 16.2%. And what about their cash position? Well, their total cash and cash equivalents stood at RMB 178.8 billion as of June 30, 2025. That's a healthy amount. Gives them significant breathing room, to manage operations and fund growth.
Like having a decent safety net while they're juggling all these changes.
Yeah, exactly. And here's another interesting little piece. Profit from other revenues more than doubled. Increased by an impressive 110.3% year over year.
Wow, over double. So for you, our listener, these numbers mean understanding the foundational shifts. They're growing in specific targeted areas, their revenue streams are evolving, and they're making real progress on profitability. But it's not like uniform explosive growth across the board. There's a lot of strategic finesse happening.
Precisely. And that return to positive adjusted corporate EBITDA in particular. It's a strong indicator that the operational adjustments are having a real, tangible impact on the bottom line. Even with everything else going on, it's a blueprint, frankly, that many legacy fast casual brands are still struggling to perfect.
Okay, you've laid out the financial picture, which is, quite complex. But let's unpack the real drivers. How exactly is THCH orchestrating this growth? Where are they seeing the forward momentum?
Well, the primary engines driving them forward seem to be a really aggressive store expansion strategy, specifically through a heavy pivot to franchising and a massive push into digital transformation and customer loyalty. They're not just opening stores, they're opening a specific kind of store and engaging customers in these incredibly modern ways.
Let's talk about that store expansion strategy first.
Yes.
What's the new blueprint look like?
So they've significantly expanded their footprint, now operating in 98 cities. A key part of this is that dramatic pivot to a franchise model. By the end of Q2, over 400 stores had been converted to franchise, and the number of franchise stores specifically jumped from 333 to 449 year over year. CEO Youngchun Liu has set a clear target, opening around 200 new MTO stores in 2025.
MTO stores, made to order.
Yeah.
What's the significance of that specific model? And you also mentioned sub-franchise stores. What does that mean for their growth?
Right, so MTO, made to order, these are their newer, more efficient formats. They're optimized for speed, modern customer preferences, often smaller, very digitally focused, maybe less dine-in space, just designed for a quicker, more streamlined experience. And focusing on sub-franchise stores. That lets THCH extend its reach even further through local partners. Think of it like a main franchisee brings in other local operators under their umbrella. It allows for even faster, more localized expansion with minimal capital needed from THCH directly. It really accelerates that asset-light growth model they're aiming for. They expect over 100 net openings this year, and then looking ahead, a consistent 200 to 300 new openings annually.
So, leveraging partners to expand reach and doing it with a more modern store design.
Yep.
That really showcases a clear pivot, doesn't it? A different, more asset-light growth model for you, our listener, to watch.
Precisely. And alongside that, their digital transformation efforts are, well, truly eye-opening.
I saw some numbers on that. They're pretty staggering, yeah.
They really are. Digital orders accounted for a staggering 90.4% of total orders in Q2. That's up from 86.5% just last year. I mean, that means they've almost completely transformed the customer journey. Honestly, sometimes I wonder if their physical cash registers are just collecting dust. It's practically how their customers interact now.
90.4% digital orders.
Yeah.
Wow. That's a massive shift. It really underscores how absolutely critical their online presence, their app experience must be for their continued success.
It absolutely does, and it ties directly into their loyalty efforts. They're building this highly engaged digital ecosystem. Registered loyalty club members grew by a solid 22.4% year over year, reaching 26.2 million. That's impressive. And their monthly average transacting customers also increased by 14.3% to 3.59 million from Q2 2024. The CEO specifically noted these loyalty members are an incredibly valuable asset. The company is actively working on designing products, campaigns, to encourage them to spend more when they visit.
So connecting this to the bigger picture, they've got their footprint expanding through this smart asset-light franchising, and their customers are overwhelmingly digital and seem quite loyal. That feels like a powerful combination for their long-term strategy, right?
Yeah.
Building a strong foundation for recurring business.
It truly is. This suggests a highly effective digital strategy and a laser focus on building that loyal, engaged customer base, which is just crucial for sustainable growth in the modern fast casual world.
But it's not just about opening new stores and racking up digital orders. There are some equally interesting and deliberate shifts happening internally too, right? They seem to be making some tough choices about their existing business model.
Absolutely. THCH is undergoing a significant strategic overhaul, moving away from that more traditional company-owned model towards this franchise-heavy approach, and all while implementing these focused cost management initiatives. This isn't just organic growth, it's a full structural transformation they're attempting.
Let's talk about that shift to the franchise model then. What do the numbers tell us about its impact, especially on their, company-owned stores?
Yeah, the numbers are quite telling. Revenue from franchise and retail businesses up an impressive 50.7% year over year. But on the flip side, company-owned store revenue decreased by 12.5% year over year. And this wasn't an accident. It was due to planned closures of underperforming stores. In Q2, they closed 49 stores. And 41 of those were specifically non-MTO express stores, those older, less efficient formats.
So they're actively closing stores that aren't performing, especially the older model ones. Streamlining operations. That takes guts. I mean, chasing growth is one thing, but pruning underperforming assets, that's a sign of disciplined management. But how quickly, how effectively can they manage that transition? Keep brand consistency, customer experience steady across this expanding footprint.
That's the critical question, isn't it? And it speaks to their operational agility. Coupled with that, they've made significant strides in cost management. Food and packaging costs were reduced by 0.8 percentage points year over year, now 30.1% of company-owned store revenues. Labor costs also saw a reduction, 1.0 percentage point year over year, and overall general and administrative expenses decreased by 5.2% year over year.
That's a lot of efficiency gains in some very key areas. So it's not just about what they're bringing in, but how smartly they're spending it. It really highlights that clear, deliberate strategic direction away from the older, less efficient models.
Exactly. This focus on tightening the belt while simultaneously expanding, that's a hallmark of a company serious about getting to sustainable profitability.
Okay, but of course, every growth story has its headwinds. What are the challenges THCH is actively navigating as they push forward with this pretty ambitious transformation?
Right. While there's a lot of positive momentum, there are certainly areas where THCH faced challenges, particularly concerning, say, sales performance nuances and rising operational costs. It's a complex balancing act, requires constant attention.
Let's unpack that sales performance. I saw something interesting about same-store sales versus transaction growth. Can you clarify that distinction for us? Because it sounds a bit counterintuitive.
Yes, and this is a crucial nuance. They reported positive same-store transaction growth of 3.4% in Q2. So more people are engaging, making purchases at existing locations. That's good. However, same-store sales growth, the actual revenue generated by those existing stores, it decreased by 3.6% year over year. So this indicates that while the volume of transactions is up, the value of those sales may be due to average check size or pricing strategies or promotions actually declined. It's a key area to watch. Definitely impacts overall revenue from their established base.
Okay, so more people are coming through the digital doors, making transactions, but the actual value of those sales in existing stores is a bit down. That's a classic balancing act, isn't it? Driving more engagement versus getting them to spend more once they're there.
Precisely. And alongside this, they experienced rising costs in certain areas, delivery costs, for instance. They increased to 11.8% of revenues, up 1.8 percentage points year over year. This was driven, unsurprisingly, by a higher delivery revenue mix. With 90% digital orders, a lot of those are likely deliveries, which, convenient for the customer, but it adds to the company's cost structure.
Yeah, that makes perfect sense. Convenience always has a cost, right?
Yeah.
Especially when it becomes the dominant customer channel.
Right. And marketing expenses also increased, rose to 4.0% of total revenues, up half a percentage point year over year. That impacted profit margins. CEO Lewis explained this spend supported their successful Lunchbox campaign. He credits it with contributing to that historical high food contribution in Q2, and he actually expects this trend to continue. Additionally, rental and property management fees increased by 0.9 percentage points as a percentage of revenues, largely attributed to that decreased same-store sales volume we just talked about.
So they're making a calculated investment in marketing. They believe it's paying off in food sales, but yeah, it's also eating into margins. And you also mentioned something about external warning signs. What's the context there?
Yes, it's important to note, Guru Focus, which is a financial analysis firm that tracks investment data, has detected 3 warning signs with THCH. Now, these are typically flags for things like declining margins, maybe excessive debt, negative cash flow trends, areas investors need to watch closely as the company navigates this transition. So while the CEO is confident the increased marketing spend is a calculated investment, these warning signs kind of serve as a reminder. Their strategic moves need to show consistent positive returns in the coming quarters to really alleviate those concerns.
Okay, so we've looked at where they are, the good and the challenging. Now, what's the plan? How is management addressing these challenges and building for the future, especially with those, warning signs on the radar?
Well, management's outlook, judging from the Q&A and the earnings call, paints a clear picture of their forward-looking strategies. They're focusing on continued store model refinement, careful capital management, and a strong belief in their marketing and loyalty efforts. They're not shying away from the hard work, it seems.
Let's start with their future store growth and strategy. Sounds like they're being very deliberate about which stores they're opening and which ones they're keeping.
They are. The company is committed to continuing to improve underperforming stores, both company-owned and franchised, especially those older non-MTO express stores. And if improvement isn't feasible, they seem willing to close them. In Q2, they had 31 net openings of the MTO stores. That's excluding those planned closures. Their target remains ambitious. 200 new MTO stores in 2025, mostly sub-franchisee. Expectations are over 100 net openings this year, then that consistent 200 to 300 new openings annually in the coming years. It clearly emphasizes that asset-light, MTO-focused growth model.
Right, so the message is clear. More of the new efficient stores, fewer of the old ones. What about capital? Growth needs investment, but they also just got back to positive EBITDA. How are they balancing that?
That's where CFO Dong Lee's comments were interesting. He stated they returned to positive adjusted corporate EBIT this quarter and are actually close to full-year adjusted corporate EBITDA break-even, which indicates they're nearing self-sufficiency in operating cash flows. That's big. However, they are still actively working on securing additional capital, bank loans, financing plans. This capital is intended specifically to open more profitable company-owned stores, so they're being selective while carefully balancing their financial position overall. They also mentioned making good progress on refinancing their convertible debt, with details apparently coming soon.
Okay, so financially getting stronger, closer to being cash flow positive from operations. But they still need to be smart about funding future growth, especially if they plan to open some new, highly profitable company-owned stores alongside all that franchise expansion.
Exactly. It's about being strategic with capital. And on the marketing and sales outlook, CEO Liu expects positive same-store sales in Q3 and the second half of the year. He firmly attributes that Q2 marketing spend to the successful Lunchbox campaign and its boost to food contribution. Suggests they view the marketing spend as a successful investment, not just an expense, one that will yield further returns.
And what about those 26 million loyalty members? That's a huge base. How do they plan to get them to spend more, really leverage that?
Yeah, that's an ongoing effort and clearly a major focus. Management views those members as a tremendously valuable asset. They're actively working on designing specific products, specific campaigns to encourage them to increase their spending in stores. It's about deepening that engagement and monetizing that substantial base, turning loyalty into consistent, higher revenue.
So they've got a clear plan, it seems. Lean further into the franchise model, aggressively focus on these new MTO stores, carefully manage capital, make those 26 million loyalty members even more engaged. It sounds like a busy, multifaceted year ahead. A lot of moving parts to manage there.
It really does raise an important question, though. How successfully can they execute on all these simultaneous strategies? Store closures, new openings, raising capital, loyalty monetization, all at once. To achieve that sustainable, profitable growth, especially with those warning signs flagged, it requires a really high level of operational excellence and strategic agility. And their Q2 earnings show they're certainly right in the thick of that challenge.
Okay, so we've taken a real deep dive into TH International's Q2 earnings. We've seen a company right in the midst of a significant strategic transformation, emphasizing that pivot to a leaner, asset-light franchising model, driving incredibly strong digital engagement and customer loyalty, and implementing very careful cost management. It's definitely a delicate balancing act, isn't it, between that aggressive growth and managing those crucial operational expenses, particularly around delivery and marketing.
Yeah, and if we connect this back to the bigger picture, TH International is clearly betting big on its ability to evolve, the capacity to pivot aggressively towards franchising, leverage digital to build that loyal customer base, while simultaneously managing costs and pruning underperforming assets. That's going to be absolutely key to their long-term success. They're trying to perfect a blueprint, really, that many fast casual brands are striving for in today's market.
So, as you think about the future of fast casual dining, how important do you believe that balance becomes, between aggressive digital adoption and traditional physical footprint optimization? For global brands like TH International, what's your take on how they manage that blend?
Subscribe to my channel Report Stock.